Hey everybody, Jerome Maldonado. So I was sitting here reading on Biden's capital gains tax proposal that would be set to be able to what they call affect the wealthy, right? Or to tax the wealthy. And since we're in real estate, I wanted to talk to you guys about capital gains tax. And it's not just real estate. It's anybody who's investing in stocks and in anybody who has investments, whether they're angel investments or whatever they are, you're subjected to capital gains tax on all investment income that you have. Now, one of the great things about capital gains tax is that if you buy an asset and you hold the asset for less than 1 year, you're traditionally taxed as ordinary income. So it's your highest tax bracket, which, depending on how much you make, will fluctuate. But if you're of the more affluent, you're closer to the higher 39% tax bracket, because there's a 3.9% medical surcharge that they assess, 3.8% surtax, and it's for the Affordable Cares Act to fund medicine and medical expansion and so forth. And so currently, if you hold real estate for more than 1 year on your short-term capital gains, you're currently taxed at about 23.8%, okay? Now, it's really 20% federal taxes and then the 3.8% on top of that. So for a total of 23.8% on capital gains taxes currently, if you hold your real estate or your investment assets for over 1 year, your tax rate drops. And so what the Biden administration is proposing is that they would do away with that. And so capital gains tax will be the highest assessed tax that we have as Americans now, which has been one of the biggest attributes for investors investing in real estate. And so don't go off selling your assets right now, because this is just what's proposing. They have a small margin in the Senate, the Democrats do. And so that doesn't mean that this is going to pass. But everything that happened during the Trump administration to help investors is now that quick could be diminished. And so it doesn't matter if you're Democrat, Republican, this really has to do with investors, right? And so I want to talk to you guys on how this relates to real estate, your investment income, and how long-term capital gains taxes could or may not affect you. And so if this bill passes, now there's still a lot of determinations. There's still a lot of variables that are still unknown yet. They haven't spelt everything out. All the terms of these tax increases are not spelt out entirely, so there's still a lot of gray area. But the way they're reading right now is that even if you hold your assets in excess of a year, that you'll be subjected to the highest tax bracket, which is at about 39%. And let me give you the exact numbers so that way, the highest tax bracket for the wealthy right now is right at 37.5% or something. Let me give you the exact numbers, so I'm quoting you guys the exact numbers, okay? So it's at 39.6% right now. That's the highest tax bracket. Now, with the Biden administration, what they're proposing, you'll be at a 43.4% tax bracket, which is higher than any type of ordinary income tax bracket, because you have to remember that we take the 39.6% and we add the CARES Act tax for medical expansion of the 3.8%, and you take that and add that to its 43.7%. Ordinary income gets taxed at 37%, okay? And so you're going to be essentially just shy of 6% higher on capital gains tax, which is a big number, especially for people that are making over $400,000 a year. Now, if you're someone like me, most people going out and working a job, and even small business owners, don't have a net taxable income of $400,000 a year. So this decreases the amount of people that are subjected to some of this. But if you're an investor and you sell off an asset, and this is where wealth is created, this should be important to you. Even if in your ordinary income, you may not be making $400,000 a year. Even if you're making $150,000 a year, you can be subjected to this, because a lot of Americans get ahead is off of the single best tax break that we have, which is the capital gains relief. And so if a married couple right now today sells a house, they can claim up to $500,000 of that tax-free, $250,000 per head. For the wife, $250,000, for the husband, $250,000, and you can have a gain of $500,000. And that's huge for a lot of empty nesters that are in retirement age that are trying to retire to be able to sell. So a lot of markets like California, people moving out of Washington State, out of Oregon, some of the really affluent markets, New York, people moving down to Miami, they can sell their homes, which are smaller, maybe they're older, for like $1 million. What we're doing right now over in the Seattle area is we're taking people that probably at one time in the last decade, these people paid $180,000. If you go back 10 to 15 years, a lot of these people paid as low as $180,000 for these homes. Now these homes have appreciated to over $900,000 in value. And so these people have probably paid off a good percentage of their mortgage. So they have about $700,000 in capital gains. Well, $500,000 of that is not subjected to the capital gains tax laws if they're married couples, and they'd only be taxed on $200,000 of that. And so, when you think about a house that someone bought for $180,000, sold for between $900,000 to $1 million, to be able to go out and have $500,000 tax-free, then they come in and deploy it into markets like the Albuquerque market, the Phoenix market, where real estate and single-family homes are still very affordable. Texas, still very affordable. Now, Texas may change with Elon Musk and a lot of people moving over to these states and creating a lot of job growth and a need for housing, especially with the shortage that's happened in the last year with the pandemic. And so that surge of income that people get from that capital gains relief could be demolished with this. And so if you're one of those individuals, and let's say you're just an investor, and let's say you're coming into one of our syndications and you're doing a big investment deal, and we buy, we renovate, do a value add, and let's say you come in with a few $100,000 into the investment. Let's say you come in and you've saved up your hard-working cash and you have $300,000 in capital that's saved up, and you do one of these big hotel conversions that we're doing, and we bring you in as an equity owner. And let's say that we land up killing it with the deal, and people land up with a couple $100,000 on their internal rate of return that they get back. Well, you as an investor coming into one of our deals, you're also subjected to these capital gains taxes. And so now 43% of what you made out of the $200,000 can land up becoming taxable because of what you made off the investment that we made, plus what you make annually on your household income. And yes, the mean income nationwide is somewhere between $60,000 and $80,000 household income per year. But there's a vast spread between the affluent and the poor. And so there's just a lot of people that are making under that, but there's a vast majority of the upper middle class that are making strong six figures anymore. And in fact, the majority of the upper middle class are making a couple $100,000 a year, and a lot of families have husbands and wife both doing that, so they're making $350,000 to $400,000 a year. And there's a large percentage of homeowners that are making that nowadays. And so it's not abnormal, where if you went back just 10, 15 years ago, it was very abnormal for a single family home to be making $400,000 a year, $300,000 a year. And in today's day and age, it's not anymore. There's a lot of very affluent families that are both the husband and wife are both making six figures. And you go into neighborhoods, and almost entire neighborhoods now are affluent, where people are making household incomes of $300,000 to $400,000 a year. So if you add a solid investment on top of that, you, my friends, are all subjected to the capital gains tax and the capital gains hike that the Biden administration is proposing. And so we're keeping our fingers crossed that it doesn't. It's going to take some time for this to happen. And so it's nothing to go out there, be alarmed, and start selling off your investments right now. And understand that if you're going to hold your real estate, if you're going to hold your investments long term, then you don't need to be alarmed. Like, I buy and hold a lot of my assets, but we do purchase a lot of stuff that's value add that we utilize for ordinary income and utilize to be able to increase our net worth. Now we deploy that stuff, and what's great about real estate, here's what's great about real estate, is that, and you can't do this with stocks. So understand that if you're in stocks, you can't do this. You sell your stocks and you have large capital gains. What do you invest it in? Well, you can invest it into real estate. And here's what's cool about real estate, is that if you're subjected to this, you could go in and you'll be forced to buy another asset, either one of two ways, either through the means of a 1031 exchange. So we'll pray to God that that the 1031 exchange doesn't, they've been talking about changing how 1031 exchanges are structured as well. We haven't heard anything in that regards that would pose any concern at this point in time. So we'll hope to God that if they do the capital gains hike, that they keep the 1031 exchange variable in there, because that's also a great tax benefit that we could exercise as investors to be able to go out and protect our asset and in our investments long term from taxes, so that way we're not taxed at the highest tax bracket. We can reinvest it into a larger asset. Second thing you can do if you're in real estate is you can go off and buy another piece of real estate, even if you don't exercise a 1031 exchange, and take accelerated depreciation on that asset. So look, I'm not an accountant, I'm not a CPA, and I'm not gonna give you tax advice on how to take accelerated depreciations on asset. All I can tell you is this, is I'd recommend to you to get with a good CPA that knows real estate law or knows real estate taxes. I changed that. Get an attorney that knows real estate law, or a CPA that knows real estate taxes well, that they specialize in that can help you structure a purchase that will help you take accelerated depreciation on an asset, which is what we tend to do at the end of years that we have a large amount of tax liability. We'll go in and we'll exercise and purchase a piece of real estate, take accelerated depreciation, and that helps reduce our tax liability. So even if we have a hike in capital gains taxes, we can offset that by accelerated depreciation. And so there are ways. You just have to be savvy. You have to be aware, because through the means of awareness, you can make changes to what you're doing on your taxes and how you purchase and how you invest to protect yourself, your assets, your holdings, and prevent yourself and keep yourself free and clear of tax liability legally by exercising other tax laws that are existing. And so for those that are less affluent, those that don't know, or those that do not have the help by a good CPA, they will be affected by this. But for those of us who are business owners and savvy enough to understand other tax laws that can protect our assets in other ways to prevent ourselves from being subjected to some of these taxes, I encourage you guys to get wise and wisdom doing that, or work with our team and we can refer you to good people. But nonetheless, don't be alarmed yet. Investors, don't go off and sell off all your assets. This hasn't passed. This is just something that is being proposed, but this is the worst case scenario, that you could be taxed at 43.9%. These are all new numbers. 43.4% on your capital gains tax. That's a big number. Hence, for those of you guys who don't realize why we're doing stuff down in Puerto Rico, well, ladies and gentlemen, with numbers like that, it becomes very attractive and very motivating to make a big move, like going down to a place like Puerto Rico, investing in a big piece of real estate. And that's why real estate is booming in Puerto Rico right now. And really the only thing that would affect us is if Puerto Rico became a state. Now, there hasn't been any talk that that's on Biden's agenda, so I don't think that we need to worry about that on this term, although in later terms it could be an issue. They're talking about making Washington, D.C. the United States 51st state, but they're not talking about Puerto Rico being the 52nd state. So with that being said, Puerto Rico is still a solid investment and a great place to deploy your income and make a move to be able to prevent federal and state taxes, or reduce your federal taxes and prevent state taxes, and actually a really pretty place to live. And so capital gains tax, the Biden administration, and how this is projected to affect and hit the wealthy. Ladies and gentlemen, you're not too far from the wealthy yourself. And when this is classified and categorized and taxing people trying to create a retirement income through the means of real estate or stocks, this can affect you as well. So it's a serious talking matter, and I'll tell you guys, just go out there and exercise all the tools that are available to the business owners. And what I told someone yesterday is I said, look, as long as the Federal Reserve is in control of printing money, and the central banking system is ran by the federal, as long as the Federal Reserve is ran by the central banking system, capitalism isn't going to be affected. You know, the Federal Reserve should not be printing money based on our constitutional rights. The government should be, but since the government gave that right to the central banking systems to put the Federal Reserve together years ago, ladies and gentlemen, they have the ability to print money, and it's capitalism in full effect, good or bad. It's not the greatest thing in the world. I think the federal government should be printing money instead of the Federal Reserve and the central banking system being in control of it. But if you guys don't realize, you guys may have heard me talk about it, the Federal Reserve is a non-governmental agency. And the Federal Reserve is a private entity which is ran by the central banking system, all the big banks, JP Morgan, Merrill Lynch, Chase, all the big guys run the Federal Reserve. Our federal government takes the money, and the Federal Reserve lends our federal government printed money at an interest rate that they pay back. And the way they pay that interest rate back is by your tax dollars. And so hence, all of this is getting paid back through our tax dollars. Ladies and gentlemen, capitalism, either in its most corruption, in its biggest corruption, or in its greatest form, you know, however you look at it, but nonetheless, Biden administration, capital gain taxes, and how they're proposed to hit the wealthy. For more content just like this, click below, give us a thumbs up, and subscribe to our YouTube channel. Click on that bell for notifications every time we have more content just like this.